What's going on, everyone? Zach Gent here, real estate sales representative with Remax Real Estate Center in Cambridge, Ontario. And today I'm bringing you a little bit different video. I sat down with my good friend, Jenny Lynn, who is a mortgage agent with Mortgage Alliance. And I got her on a Zoom call, got her out of her comfort zone, and I sat down and talked to her about mortgages and just kind of what's going on in the real estate market today. She gives a ton of good information, so please, sit back and enjoy my interview with her over Zoom. Well, hello, Jenny. Thank you for joining me.
Thank you. Thank you for having me.
So for those who don't know, can you just introduce yourself and say who and what you are?
My name's Jenny Lynn, and I'm a mortgage agent with Mortgage Alliance.
And when you say mortgage agent, is the term mortgage broker kind of exchangeable with that?
So a mortgage agent and a mortgage broker, they have a different license than I do, but we could all do the same job.
Can you tell us the big difference between using yourself, so a mortgage agent or a mortgage broker, as opposed to going to my bank that I use every day? What would be the biggest difference?
The main difference would be banks have one product, right? So they offer you the one rate, it's their one product. Whereas as a mortgage agent or broker, we have access to well over 100 lenders. We kind of shop the market to find the product that suits the client's needs. At the bank, they're bank specialists. So when you go to a bank, it's a bank mortgage specialist. They're not licensed through the government. They take all your information, which they typically usually have because you're going to your bank, right? So they already have all your information. But as the mortgage agent, I have to get everything from you. But with that in mind, once I have everything, I can shop around. My services are free. I'm available 24/7. Banks typically, the 9 to 5. If I pull your credit bureau for the application, that one credit bureau I can send out to however many lenders. But if say you had, a TD bank account, you went to Scotiabank, you went to BMO, all of those banks will pull your credit individually, causing your credit score to drop a little bit every time. I can offer rate protection. If approved, it's a guaranteed rate. Typically before closing, if the rates drop, which right now the rates keep going down, which is great. If the rate goes down, you get the lower of the rate.
Okay, and so when you say rate, I assume you mean the word interest rate, right?
Yes.
And so what does that mean to people who maybe first-time home buyers and don't really know what that means?
It's basically what you're paying the lender in exchange for borrowing the money. Same as credit cards, right? So you have a credit card, you have to pay the interest before you're paying the principal. There's typically two kinds of interest rates for mortgages. So you have your fixed rate or your variable. Fixed rate is it's fixed. It's your mortgage payments are this much goes towards the principal, this much goes towards the interest. The variable rate, it's a little different. So variable rate works as it's usually prime plus or minus, and prime is the Bank of Canada rate. Whatever the prime minus is, say it's prime minus 0.5, your interest rate would be 1.95. But if the prime rate goes up, then your interest rate obviously goes up. That being said, whatever's in that interest rate, it goes either to the principal or the mortgage, right? So if the variable interest rate is low, more is going to the principal. Once the interest rate goes up, more goes towards the interest rate. And it's always a discussion with clients individually, what they feel comfortable with. A lot of people like that fixed. They know principal, interest, and that's it. So it's one of those things you just I have to discuss with each individual client.
Right. I've kind of always been told, I don't know if this is true or not, that over time, the variable works out to be a better thing overall, but you can deal with that up and down, right?
Yeah. And especially during these times, it's weird. Like our prime rate is great right now. It's low, bringing, your mortgage interest rate down, but something has to give, right? During these times, like who knows? At one point, prime was 3.95. So if you can imagine 3.95 plus 0.5, then your interest rate is well above 4.
And when someone gets an interest rate with you, that's where you get into, it's not for the whole mortgage, right? It's just for a short term.
Yeah, typically the most standard product is 5 years, a 5-year term. Some people will do a shorter term. It depends. The best products are the 5-year terms though.
And you mentioned before, someone's got to give you all their stuff. So if I wanted to come to you, I'm a first-time home buyer. I want to come to you, and you're going to find me my best mortgage I can get out there, my best rates. What documents or what information do you need for me to collect or give to you so I can get a mortgage?
So for starters with that, we always do a 2-year average. So we would need like 2-year T4s and 2-year notices of assessment through CRA. If you have any other income additional to, say, your salary or hourly, but you have a rental property or you have any other income like the child tax benefits, things like that, sometimes lenders will ask for 2 years of your T1 generals. I always like to collect everything first because in that way there's no questions when submitting even for pre-approval. So those income docs, we always need a recent pay stub, letter of employment. The letter of employment has to be dated within 30 days of the application. And then there's the proof of the down payment. So if you're a first-time home buyer and you're using your RSPs, we need the 90-day history of where the RSPs were and the bank account that they get deposited into. If you're getting a gift, every lender has their own gift letter. It has to be by an immediate family member, and all the lenders need to see is the gift letter signed by all parties and the deposit going into the account of the client. No cash in hands. Please, everybody, no cash in hands. Nothing under the bed. We need the history. And then proof of closing costs. So it's a standard rule that we ask for 1.5% of the purchase price for proof of closing costs. So they want to see that in a bank account as well. I always advise clients, if they don't have a CRA account, to just log into the CRA and register. And you can pull everything from there: T4s, NOAs, statement of your balance if you have outstanding balance, to show that it's at zero by the time it closes. It's quite the process, and I do find a lot of people are overwhelmed because when you do go to the bank, they already know everything. They know your pay, they know your job, they know your credit card balances. So it's a bit daunting, but thank God for online and technology because everything's pretty much at the click of a finger, right? So,
and then the argument being that it might be slightly easier to go to my bank, but I'm only dealing, if I went to Royal, I'm only dealing with the Royal bank stock or the Royal bank lender, as opposed to I jump through a couple more hoops with you, and then you have a lot more options. Right? Yeah. So there's a term out there called the stress test. Can you explain exactly kind of what goes into the stress test and how that's changed recently? Because it's kind of, in my eyes, lowered, I guess, a little bit.
Yeah, so the stress test was introduced by the government in 2016. It was basically put in place for the just in case interest rates skyrocket. So initially it was at 5.19%. So everybody, regardless of income, anything, they had to qualify at 5.19% interest rate. It has since dropped and is now at 4.79%. It's to avoid what happened in the States so many years ago with all the foreclosures and everything. So it qualifies you at 4.79%. And then you obviously get whatever interest rate that is posted. It's basically based on your debt to income ratios. I have found a lot of people will go on to, say, a CIBC or a bank website and their mortgage calculators. So when you go into the mortgage calculator, it says, how much can you afford? And, you put in your income, your estimated debts, whatever. That's not true to an application because they're not taking into account the 4.79. So say you were to go online and you're like, oh my God, I can qualify for a $500,000 house at 1.99 interest rate. Well, it actually should be 4.79. Hopefully it goes away, but.
Yeah. You find the stress test is more hindering than helpful?
100%.
So you mentioned you threw out $500,000. So moving on to my next question. So let's say I get approved for $500,000. I go to you, you say your approval is $500,000. Should I be looking to buy a home like right at $500,000, or should I give myself a buffer?
I always like to sit with the client and kind of go over their monthly budget. So if you get approved for $500,000, I will show you what the monthly payment is. And then I will say, sit down and what's your insurance? What's your car insurance? What's your credit card payments? Kind of break down your budget to see if you can afford that $500,000. Qualifying purposes, it says you can, but in reality, right, everyone is different.
So $500,000 tends to be like most of your extra dollars are going towards a mortgage payment, right?
Yeah. And you don't want to be house poor, but at the same time, it's the market.
So when you're dealing with lenders, and this is different than if someone went to a bank because they only have the one person to deal with. So when you're dealing with lenders, I've heard the expression, there's an A lender and there's a B lender. What's the difference and what does that mean to me, an A lender and a B lender and that?
Okay, so I'll start out with the A. So A lenders are like the prime of the prime. So A lenders are all major banks, places like First National, RMG, MCAP. Credit score has to be really good, usually 680 and above. Your credit score has to be 680 and above. There's no lender fee. I'll get into that once I go to the B side. It's best for clients with the higher credit score and no delinquencies. So no late payments, collections. If you have a client who, say, did a consumer proposal or a bankruptcy, it has to be 2 years clear and free, right? Like discharged 2 years after the discharge. They're the best rates that are out there. So on the A side, clients have to qualify based on the debt servicing ratios, more math numbers, but basically the debt servicing ratios are a percentage of your debt to income.
Okay.
It's at 39, 44%. If you go to a B lender, say you don't qualify for that $500,000 house based on the A side, but you have 20% down. So B lenders, you have to have 20% down, and there's a lender fee of 1%. So always keep that in mind.
1% on what?
The purchase price.
Okay, and you pay that monthly, annually?
Immediately. So
one-time 1% payment?
Yeah, it's in the closing costs, right? But their debt servicing ratios are typically higher. So some B lenders can go up to 50% debt ratios as opposed to 39, 44. So you don't qualify on the A side, but you have that 20% down and that 1% lender fee. You can qualify on the B side. It's for people with bruised credit. If they have a consumer proposal or a bankruptcy that isn't within the 2 years, some B side will take that into account. It's all in the story, right? And how we present it to the lender. That's pretty much it. And then we have privates and mix. They're very high interest rates, but they're for people that don't qualify for anything on the A or B side, but they do have the money. It's a temporary solution to get them to the B and then eventually get them to the A.
Right. So if I start in one category, let's say because I had a bankruptcy in the last 2 years, I started in B, and then I have that for 5 years, I can go to A if everything else looks good after the end of my next term, right?
Yeah. And Bs are generally shorter terms anyway, like 1, 2, or 3 years to kind of get you back on track so that you're not locked in for that 5 years. A side right now, you're seeing 1.44s, 1.94, like very low. B side, depending on credit score as well. So on the B side, they look at the credit score. So on the B side, you can range from like 2.5 to 4.5.
This question is close to my heart because it affects my job a lot, and I want your opinion on it. Should somebody be getting approval or somebody be in contact with you even before they start going to look at homes?
100%. When I talked about that whole mortgage calculator thing online, a lot of people will do that and be like, no, I went on the bank and they said I can get approved for this. Well, in this market, there's no conditional offers, right? Everything's firm. So you don't want a client going in firm and then going to a mortgage broker or even a bank and not getting approved.
Right. And typically how long does it take in general? I realize every situation is different, but I contact you on Monday. When am I getting approved for my mortgage? If everything's up and up.
Yeah. So as soon as I have all the documents, it's generally a 24-hour turnaround.
But to have that peace of mind, to take a day or two, or if it ends up being a week, whatever, to sit down with you, go over your numbers, and then come to me and go, I know exactly what I want. I know exactly where I'm at. It just makes everyone's life and stress just way
Yeah.
better, right?
Yeah. And I'll underwrite the deal before the pre-approval. So I will get all the income documents up front so that I know, okay, your income is this, hopefully your credit, and then, yeah.
So if I go to you, and you go and find a lender for me and I get a commitment letter, correct?
Yeah.
And how long, what's a commitment letter and how long is it good for?
So the commitment letter is what the lender gives for an approval, I guess you can say. It has all the legal terms on it. It has the rate, the monthly payments, the names, everything like that. It's basically like the legal document that gets you to get your mortgage. For the most part, they're good for 120 days. So your rate will be on the commitment letter, and say the rates go down in that 120 days, you'll get the lower of the rate, even if it keeps going down up until closing.
Hmm.
If the rates go up, you don't go up. You stay at that same rate.
So it really doesn't hurt you to get a commitment letter sooner rather than later. Because if it goes down, good for you. If it goes up, well, then you're stuck with whatever today's rate is.
Right. So lenders won't issue a commitment letter if there's no purchase and sale agreement.
Oh, I see.
Right. So the pre-approval is one thing, and then the commitment letter is issued once a purchase has been made.
Okay. So before we go house hunting, I should be getting a pre-approval.
Yes.
Does that have the same stipulations with the interest rate and that if it goes up or goes down?
Yeah. Yeah.
Okay.
And typically 120 days. I've seen some at 90 days, but that's usually like the B side.
Okay. So commitment letter and pre-approval are very similar, except one happens before the deal and one happens after the deal.
Pretty much, yeah.
When it comes to down payments, there's a lot to go on, and people get confused, especially first-time home buyers. So let's just stick with a simple number. So there's 20%. You already mentioned 20% for the B lenders, but everybody can put down whatever they want, right? So, but why is 20% the magic number?
So if you have under 20% as a down payment, you have to get basically it's what's called default insurance. So the default insurance is through government regulated companies. It's CMHC, Genworth, and Canada Guarantee. Under 20% down is more risk for a lender, and so they have to insure it. So I'll give you an example. So again, we'll do the $500,000 property. So if you have 10% down, that's $50,000. So you think, oh, great, I have a mortgage for $450,000. But because you have under 20% down, you have to pay those mortgage insurance premiums, which brings your mortgage now to $463,950 because of those premiums. So those premiums are included in the mortgage. If you have 20% or more down, then it's an uninsured mortgage, so there's less risk. And basically, the mortgage is what the mortgage is with the 20% down. There's no premiums that you have to pay.
Is it true or not true that on paper, if I had an uninsured mortgage, my rate might not look as good as an insured mortgage?
You might have a little bit of a higher rate on an uninsured mortgage, but you're not paying those premiums. So your payments will actually be lower.
Right. So even though on paper, oh, my rate's 1.6, and then this insured mortgage is 1.5, my 1.6, my monthly payments are way lower.
Yeah.
Because I'm not paying that insurance premium.
Exactly.
Obviously, so we're sitting here in February of 21, and we're still in the middle of COVID. So how has COVID changed all this? So for me, it's changed a lot with how I show home or doing more virtual. We were kind of talking before about, you're doing way more stuff from home now. So how has COVID just kind of changed getting approved for a mortgage?
Well, the good news about COVID, I guess, changing mortgage interest rates, because they keep dropping. I don't know why. It's crazy, but that's the good part of this whole thing. And the Bank of Canada prime rate has maintained really low, so they haven't even bumped up. And it's pretty much predicted that interest rates will stay low until 2023. The bad part of it is people losing their jobs. So, say you're coming up for renewal and you're like, oh my God, that interest rate's awesome. With this lender, can I switch? Well, did you lose your job during COVID? And if you did, then that's part of the story where the lender will be like, well, because we don't know what the future holds with all of this, are you going to lose it again? I found like the employment verification part, lenders will still call the employer to verify that that person works there. Whereas before it was like, if you have a really high job, they would take that as face value, with the T4s and the NOAs and job letter and whatnot. Another thing that changed were the mortgage deferrals. So remember last year, whoever it was in the government world was like, you can defer your mortgage. Well, fast forward to now, like I had a client whose bank called her and said, you can defer your mortgage. So she did. And then they wanted to renew because the interest rates were low, but they couldn't because they deferred their mortgage. So they had to be 30 days free of a deferral. But then that whole story, client story come into effect. So why did they defer their mortgage? How come they don't have, savings? How come their debt isn't paid down? So the mortgage deferrals was a big thing as well that affected things.
So as you wrap up, like what would be the best advice someone who's, either getting a mortgage for the first time as a first-time home buyer, or maybe looking to switch and take advantage of the low interest rate? Like what's the best message you can give somebody?
For starters, everybody keep all of your income documents and know where they are. I know it's a pain in the butt, but having those, we always have 2-year T4s, NOAs, T1 generals. Just keep collecting them. Reach out to a mortgage agent, mortgage broker. Have them shop the market for you. Banks are very easy and convenient, but they have one product. Go online, open up your, register for your CRA account. Takes 10 days for them to send the code. But then that way, everything's at your fingertips. So that say in 3 years you want to renew, guess what? You can go on your CRA and get me your documents. Get a pre-approval before you start looking.
Yes, no kidding, right?
Yeah.
So if anybody ever deals with me, you're the person that I recommend too. But if someone's maybe watching this who doesn't have contact with me, how can they contact you?
So I could be contacted through my cell phone, text, call, whatever. It's 519-239-4863. Or email me at jennylynnmortgages@outlook.com, and I'd be happy to guide you through the entire process. I love it.
Awesome. Well, thank you for your time, Jenny.
Thanks for having me on, Zach.
No problem. So that's it. I hope that you enjoyed that. It was a lot of fun talking to her. We had a lot of laughs. Maybe one day I'll make a blooper video about it because it was great. And of course, if you have any questions whatsoever, you can feel free to contact her. As always, you can contact me through my email or my phone, which is always at the end of every video. And please consider heading over to zachgent.com. You can sign up there for a free home evaluation, or if you're a new home buyer, you can also sign up for my free home buyer guide, which I created. I can send off to you. So until next time, everyone, please take care of yourselves, all right?